If you're preparing to sell your business, your biggest hurdle isn't just finding a buyer, it's the massive tax bill waiting for you at the finish line. When you sell a highly appreciated asset, the government usually wants its share of capital gains immediately. But there is a way to keep your money working for you longer: the Deferred Sales Trust, or DST. A DST is a tax deferral strategy that allows sellers of highly appreciated assets to defer capital gains tax over several years. Instead of selling your business directly to a buyer for a lump sum, you sell it to a dedicated, irrevocable trust in exchange for an installment note. The trust then sells the business to the end buyer for cash. Because you received an installment note rather than the full cash proceeds, you only recognize gain as you receive payments from that note over time. Why go through this extra step? There are four major advantages. First, it spreads out capital gains taxes over time, allowing the principal to stay invested longer. Second, the trust can diversify the proceeds into various investments, such as private equity, real estate, or public equities. Third, it provides a predictable stream of passive income tailored to your needs. Fourth, the value of the installment obligation is generally frozen for estate tax purposes, protecting future appreciation from being included in your gross estate. However, this isn't a set it and forget it strategy. It comes with real trade-offs. It involves significant setup fees and ongoing management costs for legal, trustee, and investment services. Second, you give up immediate access to the full lump sum of cash and are locked into an installment schedule. Third, to satisfy the Internal Revenue Code, you must relinquish full control of the proceeds to an independent trustee. The trust cannot be a puppet or economic serf of the seller. It is critical to distinguish a DST from a monetized installment sale. Monetized sales involve receiving the sale price in the form of a non-recourse, unsecured loan after the sale, which the IRS has labeled a dirty dozen abusive transaction. A legitimate deferred sales trust does not involve these types of purported loans. A hypothetical scenario for a $5 million stock sale using a deferred sales trust illustrates how a seller can defer significant upfront taxes and instead grow their wealth using pre-tax proceeds. Imagine Jane, a founder, holds $5 million worth of stock in her company with a $1 million cost basis, meaning her total capital gain is $4 million. If Jane sells her stock directly for a lump sum, she will have an immediate tax bill at a combined federal and state rate of roughly 23.8% to 30%, including the net investment income tax. She might owe $1,190,000 in taxes the following April. Accordingly, Jane is left with approximately $381 million to reinvest for her retirement. Instead, Jane implements a DST strategy before the sale. First, Jane sells her $5 million in stock to a newly created irrevocable trust in exchange for a $5 million promissory note. Second, the trust then sells the stock to the final buyer for $5 million in cash. Because the trust's cost basis in the stock matches its sale price, it pays no immediate capital gains tax. Third, the trust holds the full $5 million and reinvests it into a diversified portfolio of stocks and bonds. Finally, the trust pays Jane interest-only payments at 6% interest for the first 10 years. Jane receives $300,000 per year in passive income, which she reports as ordinary income. As long as she does not receive principal from the sale, she continues to defer the $1.19 million capital gains tax bill indefinitely.